If you are a homeowner age 62 or older, surely you run into the question of whether or not you should reverse your mortgage. It's a big decision and one you should not take lightly. But I run into so many people that brush off the question without understanding exactly what it is that they're saying no to. It's probably very likely that when you hear the words reverse mortgage, the next word that comes to mind is scam or predatory or where the bank takes your house away. It's an emotional, conditioned response and unfortunately not very well informed. It's because everyone has heard the horror stories surrounding reverse mortgages or financial gurus that claim that you should only be using them as a means of last resort. But when do you ever hear stories of people that use reverse mortgages to level up their financial game?
Anyone? Anyone?
And when do you ever hear of people that go out to lose their home, their way of life, or their actual life because they didn't get a reverse mortgage? I have heard these stories, and this is why I believe that it's a big decision, a way you should not take lightly, and you should be well informed. And so this is why I am making this video. It will answer 5 questions that you should be asking yourself right now if you're a homeowner age 62 or over in informing what is most likely the biggest financial decision of the rest of your life. So number 1, what is a reverse mortgage? It's not a grant. It's not free money. It's not where the bank takes your house away. It's not even where the bank takes your house away when you run out of equity. It is... It's a mortgage lien. That's what it is. It's like a traditional forward mortgage with the number one difference being in the way that it's repaid. So with a traditional forward mortgage, you're going to pay it every month for a set term. Now, with a reverse mortgage, monthly payments are optional. You can make payments if you want. There are plenty of people that do so that the loan balance doesn't grow. But the beauty of it is that you don't have to. Let's think about why this is. Why is this even a feature of reverse mortgages? Well, in retirement, your income is typically considerably less than in your working years, and you're no longer in an accumulating phase of your life. It's a phase of your life where you use what you have worked so hard on accumulating. And the last third of your life is one of the most important times to be able to preserve your assets, as you're more vulnerable to falls or physical ailments that can result in sky-high medical bills. Reverse mortgages offer flexibility to senior homeowners, providing them with financial safety that a forward mortgage can't. This is why, if you're going to have a mortgage after the age of 62, this is actually the safest kind of mortgage that you could have. You don't have to use up your hard-earned savings on a mortgage payment, and you won't lose your home for not paying it. So when does repayment occur? Reverse mortgages have no set term. Repayment happens at the end. Then of what? So the end of a reverse mortgage occurs at a maturity event at which repayment happens in one lump sum, either with the sale of the property or with a refinance. A maturity event occurs when the last borrower passes away, moves out of their home, or sells their home. I will add here that it can also happen if a borrower breaches the contract, and we'll go over that a little later in the video. Be aware that a unique feature of this loan is that you must use your home as a primary residence. That is to say, you must reside in there at least 6 months out of the year, plus 1 day. And the lender will check. They send mail to your home. So don't go moving to another state and trying your hand at Airbnb because the lender will check. Question number 2. How does it work? Well, basically, it's a catch-up refinance. If you have a mortgage, it will be paid off, fees are added to the loan, and if there's any remaining equity, you can take it out as cash. Now, because the repayment is different and monthly payments are optional, There has to be enough equity in your home for the loan balance to grow as interest accrues every month. Unlike a forward where you're able to take out 80% of your home's equity, in a reverse, a principal limit will be determined based off of three things: your home's value, the interest rate at the time of locking your loan, and the age of the youngest borrower. So let's talk about the two things here that differentiate a forward mortgage from a reverse. At the time of this recording, interest rates are high, which means that principal limits for reverse borrowers are lower than at other times. Consider this: high interest rates go hand in hand with inflation and high home values. So the higher the value, the higher your principal limit. Now let's move on to age. With a forward loan, age is not a consideration at all. 80% is usually the max cash out that you can take from your equity. And even if you're 100 years old, you could do a 30-year mortgage. With the reverse, the younger you are, the longer your life expectancy, and therefore the lower your principal limit will be. You could conceivably take out a reverse mortgage at 62 and not have to pay it back for 40 years. Heck, you may not have to pay it back for 50 years. You heard of the guy that paid $2 million a year to be 18 years old again? Now, I recommend you get your hands on a reverse mortgage amortization schedule, and by looking at the numbers, you'll begin to understand how these loans are designed to preserve equity while also accumulating interest. That's because they take into consideration your home's future appreciation. There's always a chance your loan can exceed your home's value, but FHA ensures that you or your heirs will never owe more than 95% of your home's value. Number 3, do you qualify for a reverse mortgage? For the most part, whether you qualify or not will depend on the amount of equity you have as your home is cut up for collateral. There will be a credit check, but it's not to determine your interest rate or even your eligibility. It's used in a financial assessment. Now, sit down because what I'm about to say may challenge a preconceived notion. Reverse mortgage lenders aren't standing by waiting for any reason to foreclose on your home. On the contrary, lenders use the credit check to conduct a financial assessment, and they do this because they actually want to prevent seniors from breaching their contract. The credit check will help determine your residual income so that they know that you're both willing and able to pay your bills so that foreclosure does not occur. All homeowners, whether you have a reverse mortgage, forward mortgage, or no mortgage at all, must pay their bills. In the case of a free and clear home, you have to pay taxes and any HOA dues, or guess what? You can get foreclosed on. If you have any type of mortgage lien at all, you have to pay your insurance and keep your home in an insurable condition, or guess what? You can lose your home. So let's stop using reverse mortgages as punching bags for why seniors lose their home, and let's all fully get on board that homeowners have homeowner responsibilities. You have to pay your bills. If a financial assessment determines that you do not have the willingness or ability to pay your bills, you may still be able to qualify with what's called a LISA. A LISA is a pool of funds set aside from your total available reverse mortgage loan amount. It helps pay for property and insurance charges throughout the estimated life of the loan. It's like an escrow account that are used with forward mortgages where the lender sets up an account to make property taxes and homeowners insurance payments on your behalf. The amount of funds to be set aside in a LISA is calculated by multiplying your expected lifespan in years by your projected property taxes and homeowners insurance. You will get less cash back with a LISA, but think about it. If you get up there in years and you become forgetful, this is the ultimate scenario that will provide you with financial safety and peace of mind. And this peace of mind can go a long way in making your golden years as relaxing and carefree as possible. Number 4, what are the benefits of a reverse mortgage? Now, the precise benefit will depend on the loan scenario. If you're someone that has a free and clear home, the benefit would be accessing tax-free cash that you do not have to pay back as long as you live in your home. 3 ways that the cash can be accessed is a lump sum, a credit line that grows, or monthly payments, or a combination of the 3. For others that do not have enough equity to cash out, but enough to pay off the mortgage, the benefit is stopping the monthly payments and enjoying more cash flow. There are no limitations on how you can use the money or increase cash flow for that matter. You can pay off debts, do home improvements, save for medical emergencies, invest in your grandchildren's education, purchase other properties and investment, or even cross off lifelong goals and aspirations from your bucket list. Yes. Number 5, is a reverse mortgage a bad idea? At the end of the day, all transactions are trade-offs. Every day we're trading money for food, housing, medical expenses, or maybe we're trading our time for money. In this case, the trade-off is your equity. In deciding whether a reverse mortgage is a bad idea, you need to determine if you will be needing your equity sometime in the future. If you plan on selling your home in the near future, the fees involved with getting a reverse mortgage could end up being more expensive than the money you would have saved from not making mortgage payments for a few months. You would have to do the math on something like that to determine if you can recoup the costs. If you're not 100% certain that you're living in your forever home, you might want to give some pause to a reverse. You might think that your 2-story home where you raised your family is where you will live forever until you run into mobility issues or children move away and have grandchildren in another state. Some homeowners have adult children that live in the house and will not have the means to afford refinancing the balance when they inherit the home. These are important considerations, and you will be able to identify a good reverse loan officer because they will ask you questions about your family, your home, and your plans for it, and not just qualifying questions like date of birth, income, and mortgage balance. A good loan officer will get to know you and advise you and structure a loan best suited for you and your specific goals, needs, and loan scenario. Friends, I hope you have found this video useful. I have so much more material in the works to go into finer detail to this complex and beautiful financial product, and hopefully answer any questions you may have, which if you do, you can leave them in the comment section below or reach out to me in the link below. And I hope you will consider subscribing so that you will get updated on this new material. Till next time, my friend.